Welcome back to Wash Talk, everyone, the Carwash Podcast. I'm your host, Rich DiPaolo, and joining me today, we have Jeff Pavone, founding partner, and Chris Jenks, partner and CEO of Amplify Capital Group. So great to see you both again, and thanks for taking some time to join me today.
Hey, Rich. Nice to see you again. Pleasure, as always, to be on your program.
Great to be here, Rich.
Yes, great catching up with you both. And I wanted to, as we're starting off 2025, I know this M&A topic has been something that we've talked a lot about over these last few years. So I wanted to get you both on the program to discuss kind of the current M&A activity that we've been seeing, maybe what we can expect to see here coming up in these next 12 to 18 months. And basically the general state of the car wash business and what buyers and sellers are looking for. So Jeff, you and I have talked multiple times over the past 5 years about what's motivating sellers, right? And you know, back 5 years ago, they were seeing multiples that were high and offers that many of them couldn't refuse to turn down. And we saw a lot of M&A activity. So I'm curious, Jeff, as we start off 2025, what is motivating sellers? What's bringing sellers to the negotiating table these days?
Yeah, great question. I think there's a multiple answers here. I mean, I think there's the general, aging of the operators, right? So you've got some operators that are just starting to get a little bit older. They're winding down. And at some point, they don't have really a succession plan that will allow them to hand it off to a family member. And so selling is the next logical path, right? Like any other business. And we're saying. Secondly, I think, a lot of people have come to the realization multiples have peaked. And at this point, it's still a healthy return on their investment when they sell, but they're not leaving. Before it was always a fear of leaving money on the table. I don't think they feel that way. I don't think they feel like they're leaving money where multiples are going to go sky high again. On the other hand, I think they're looking at it. We're not selling in a depressed market. So at this point, the multiple today is more than likely the multiple we're going to be getting. And then lastly, I think you've got a lot of people that got aggressive building aggressively over the last few years. And that cash burn on those new builds is coming back to prove costly. The average new build has probably got a burn of $500,000 before it turns profitable. Well, if they built 4 or 5 greenfields, they're realizing that they can start burning money in a hurry. And I would say there was a fair amount of that development speculator that thought they were just going to buy these and flip them easily. And that's causing them a lot of heartburn. And so we're saying those kind of developers exiting this business as quick as they can.
Just to add to that, too, I think that third point, just to double click a little further, that you take an elongated growth profile for your de novo strategy, right? No doubt labor output hasn't fully recovered since COVID. And for what used to be a 8-month to 1 year turnaround your new builds, those new builds are now getting longer, ramp profiles are elongated. So it's a just point that capital burn to get that new unit online and to continue down the path of growth looks a lot different today. And you couple that with competitive intensity, right? You now have a lot of well-capitalized sponsor-backed platforms that are growing around you. I think a lot of operators start to realize that with longer duration kind of growth play here, coupled with the fact that you have greater competition in your local market, may be a good time to entertain selling.
It's one thing we do, around the end of every year, Jeff, and Chris, I'm sure you're familiar with as well, is our publication puts out that top 50 list of the largest U.S. conveyor chains. So question one, were there any surprises when you looked at that list? One thing I noticed is there were chains that seemed to jump, but others that I thought would take a leap forward, maybe stayed stagnant or increase just by a few locations. So maybe that's what we're talking about here, Jeff. One of the factors is that more of them turned to greenfield development over acquisitions. Maybe that was one of the factors. But was there any surprises on that top 50 list for 2024? And then can you kind of clue us in on what types of chains are looking to acquire? What do the buyers look like nowadays that are acquiring these car wash businesses?
So the answer to your first question, any surprises? Nothing shocking yet. I think your next year's edition will have the sort of the ramifications of who's really proven out to be a good operator, developer, and who's not. And so I think we've seen a lot of status quo. We didn't see a whole lot of change last year. I tell you what, when you look at this year and next year, you're going to see that board moving, and then you'll see your surprises. But I think right now, the previous 2 years there was a lot of slow growth, except for a few guys. I think you'll see a major shakeup happening over the next 24 months, major, on that board.
Interesting. Chris, have anything to add there? Or?
No, I think everything was pretty much in line with expectations last year. Looking at the list, I mean, Mystery is a great example of that, right? I think they will projected to their earnings reports throughout the year about 40 new units going online, and it looks like they're going to hit that squarely. So I think 2024 wasn't the year of many surprises, but we're definitely seeing the markings for setup for where it could be some pretty big shakeups in 2025.
The buyer market is surprisingly different than we thought, right? We had everybody thought we're going to sort of have the same guys buying and that were already in the space. But we've had some experience with some of the top, call it 25 guys. There's a few of those guys that have gotten really aggressive. You look at Quick Whack, Club, Spotless Brands, just to name a few, have really stepped on the gas last year. And it looks like going forward, they'll continue that. On the other hand, we had Chris, like 4 new entries at least.
Oh, yeah, 4 new sponsors entering the space last year in 2024. That's correct.
And they're aggressive sponsors, so they're not looking to come in and buy 1 or 2 or 3. And they're looking to get to 100. So yeah. We've seen and I think what's driving it is a lot of the early entrants paid steep multiples to get in this business and get and build out. Today we're looking at, let's say, a multiple that might be in the 10 range of getting in and scaling. So what they're telling us, what that market is telling us, that buyer universe is saying, this car washing is still a really good business, right? They're telling us that we like this reoccurring. We like the membership is proving to be very sticky. So we're seeing some big money being poured in this space because they think the timing is better than it was before. And values are here today. So I think we'll continue to see some of that over the next couple of years.
Yeah, I agree. Just to kind of just dive in a little bit further on that. So with the emergence of the sponsors, definitely looking forward next year. And I think this is not just specific to car washing, but pervasive across all industries. I think a big driver of M&A activity is going to be coming from the sponsor community. As we look at just the abundance of dry powder and capital that's been raised in private equity over the course of the last 5 years plus, and you look at minimal deal flow in 2022 and 2023, given stresses in capital markets, a lot of these sponsors are now facing real pressures, giving challenges to meet their DPI thresholds, so distributions to pay in capital. So definitely expect to see a lot of capital recycling and a lot of monetization efforts of portfolio holdings today, but also that redeployment of capital into new deals and opportunities. And given some of the new entrants of last year, the likes of Firmament, AEA, KKR, these are really well capitalized groups that are now committed to this space.
Interesting, fellas, I'm old enough, or I've been around this industry long enough where I saw the trade shows in the early 2010s where mostly the attendees anyway would be in polo shirts, jeans, dirty sneakers, right? That you could see they might have just came from the trench or the tunnel, and they're right there. And I slowly started, and everybody slowly started seeing, back then you would be shunned if you wore a tie to the event, but you saw more suits coming to the shows, the buyer becoming more sophisticated. So it sounds like PE and large investors, they got their heels dug into this market, and they're not looking to go away anytime soon. Am I getting that right, Jeff?
Yeah, I mean for sure. I mean, I really believe, if you look out this thing a decade out, nothing happens as quick and as people want it to. I think private equity came in hot and fast. Today they're just getting the education, the knowledge base, the data to say, what does it take to manage these operations? What does it take to scale? And so I think they basically did a reset over the last couple of years and said, okay, what do we like about the business? What don't we like? But they're basically getting they're getting everything together, and we're going to see a great expansion here going forward I think growth by private equity.
That's a really good point, right? You think about the two paths forward to create value to your limited partners. There's the arbitrage in the transaction, then you have operations, of course. I think with some distortions in capital markets pre-2023, let's call it, there's a quicker path to deliver value by way of the arbitrage in the transaction, right? You could come into a deal, pay a teens multiple, and blend that multiple down by way of sale leaseback, and building on a de novo strategy at let's call it a mid-single digit multiple for your greenfield efforts. That has changed. There's now been a greater sense of urgency and focus around improving operations. I think that's one thing this industry is still getting our arms around, holistically, is there's a big gap in operating talent here, right? It is very difficult to operate in this industry. There are a few industries like car washing. I know there's assimilations to retail and hospitality, but the reality is the combination of retail, hospitality, industrial manufacturing, all rolled into one really unique business that's consumer oriented. And it takes a very specific skill set to deliver at scale. And I think there's a greater appreciation for that today.
Yeah, and just technology, a lower that sophistication of the market, the sophistication of the technology and the equipment has been in lockstep, and obviously we see the developments of AI moving into the future. These facilities are becoming much smarter than they were even 15 years ago. So
100%, we're just scratching the surface there too. I mean, that's where I get really excited thinking about a world where there's greater, adoption of AI and IoT in that car wash tunnel, because it could do some really amazing things, both in the quality of the wash, but also just engaging and nurturing with your customer base.
All right, sounds good. Well, the last 3 months, your firm, Amplify Capital Group, made the news, made the headlines on Carwash.com. Wanted to go over a few of these headlines with you. I want to get these in chronological order. So in late November, we posted on Carwash.com the news that you advised the exclusive financial advisor of Epic Shine in the Spotless Brands acquisition. Then a couple of weeks later, you were back at it. You advised Glint Car Wash in the Quick Quack acquisition, and then I had to do a double take this month in January, because I'm used to seeing your name attached to operator acquisitions, but in early January 2025, exclusive financial advisor for AMP memberships with the NCS acquisition. So what can you tell me about these last few months and these acquisitions, maybe how they came together, and maybe the significance of these acquisitions that you worked on here?
So, I would say a few things. One is sort of the Epic Shine and the Glint were sort of been our traditional bread and butter. We tend to do very well with identifying with founder-led, family businesses, right? So when you look at it, the Epic Shine, the Abel family started that business, 10 plus years ago, built a quality company. Spotless Brands, we've been working together for several months prior to that acquisition about them entering into that Pacific Northwest region. And that was, a really good target. So it was I would say from all the way around, from a buyer and a seller standpoint, we had a really good dynamics of it was the right fit, of the right opportunity, and there was going to be a lot of win-wins in that deal. And Glint, again, we were working with the team at Quick Quack even prior to the KKR deal closing. They wanted to enter that market in Seattle, and realized that the Glint team was checked all the boxes. They had the premium. They had premium assets in that market. They had a partner developer that was absolutely the best in that region, and so it was again just a perfect fit. So what we really get hyper focused on is everybody talks about price, but we look at price. We look at the terms of a deal, and more importantly, we look at the culture and the fit of the two parties coming together. And in both cases, we think it was a really good fit for all the parties. On the AMP side of it, I'll let Chris jump in on that piece of it.
Yeah, the AMP one is, a transaction that was near and dear and close to the heart for us here. So may not be aware, but we've been partners with the team at AMP memberships now for just shy of 3 years. Got to know Dennis and Adam early on and be a part of that journey with them in terms of making introductions in the car wash industry, but also helping to refine that product roadmap. And, Amplify as an organization, I know we're known for, M&A and brokerage services in the car wash space, specifically our operators. But the reality is we're a solutions provider to the car wash industry. We represent the best interest for operators nationwide. And we saw AMP as a very important change agent, delivering a very, very real need for this industry today, which is a more data-friendly and tech-forward solution set on with POS, which allows operators to better engage with their customers. And, we got to that point in the life cycle of AMP where it made sense to look for a new partner for that next level of growth, and ran a pretty intensive process and came across NCS. And, the lineage and the heritage of AMP memberships, Adam and a lot of the executive team, Liz, Matt Osher, some very talented individuals, they all came from the consulting world. They bring that consultative approach in delivering solutions to car wash operators, and NCS shares that same mission and vision. So culturally, it was a great fit. And as we know, a gap in the NCS portfolio. So excited to get that transaction on the finish line, but even more excited to see what the future holds here with the combined power of those two organizations, very talented individuals with a very innovative pipeline behind them.
Hey, Rich, and I would say on the three transactions and what they have in common, I mean, our goal as a company is to maximize the value of your car wash business. And so, you can do it multiple ways, right? We can certainly do it through our brokerage company by, let's say, adding units. We can certainly do it through our M&A advisory when we exit by the seller getting maximum value by running our competitive bid process. But I would say we looked at this thing in 2022 and said there's really a huge gap in driving value, and that gap is through operations. And so AMP just fit like a glove. Like if we're looking at improving operations, we're going to take a look at everything, and the data side of it was a big hole. So we continue to strive to drive value to the bottom line, which ultimately will help operators on an exit. So that was the kind of the initial thesis on even getting involved in the AMP deal.
You both must be reading my mind, because my next question has to do with your service offering, and I was curious, last year, your company went through a rebrand to Amplify Capital Group. I know, Jeff, you're always looking to add the best minds in the market and outside of the market to complement your services. So what is the current services offered by Amplify Capital Group? And could you briefly maybe go through the team's strengths and some new additions that you've added to the team?
Yeah, I'll let Chris take that one.
Yeah, I'll start take a first swing at that one. So, different names, slightly different branding, but same cast of characters and same mission, right? We look to maximize value and represent the best interest of car wash operators across the country. And so felt it was necessary just to refresh the brand slightly. You look at the core services that we offer today, mergers and acquisitions advisory. So helping multi-unit chains through that process of selling their business. Capital advisory, still a very big piece of what we do, unlocking capital solutions to help operators grow. This could be everything from simple debt refinancing, taking PGs and bank debt off the line to maybe put some holdco private credit facility over the top. We have a big real estate component given our brokerage heritage, which leads me to the next core service and solution we offer, which is our brokerage network. This is really leveraging the 25 plus year history of Commercial Plus Group within the Amplify Capital Group umbrella there. But beyond that, to Jeff's previous comments, we do what's best for operators. This can manifest in many different ways. the reality is we have a lot of good data and metrics. We know what good looks like. We can walk through a P&L and highlight some very real KPIs where, maybe this is an area of deficiencies for an operator to address. So we also take a consultative approach to help operators address operations. This could be in a vein of technology and offering some of the new and innovative solutions that are emerging within the car wash sector. This could also be in the form of a more traditional partnership, helping them improve or stabilize operations as they're looking to grow their chain. So the reality is we are just a solution provider and a partner to car wash operators, and that could take many different forms beyond just the transaction itself.
Yeah, the proof's really in those companies that you're at the table with, obviously Spotless Brands and Quick Quack. When you're on the other side advising a group that's being acquired by those group, certainly you're no stranger to those big names in the market and knowing them. So it sounds like a one-stop shop over there at Amplify. And I know the website recently changed. I believe it's Amplify Cap Group, CAP, capgroup.com, if I'm not mistaken. So head over there if you're looking to buy or sell in this market. But I know, Jeff, one of my favorite things with you on these interviews is having you look into your crystal ball. Chris, I don't know if you have a crystal ball or not, but these next couple of questions, I have some forward-looking questions for you. So as we look here in 2025, over these next 12 to 18 months, let's say, where do you see the car wash market, in particular the M&A activity that we see in this market? Where do you see it heading in these next 12 to 18 months?
Think big, because I think big things will happen. I think you have a lot of these platforms that started 5-6 years ago, and the private equity has a certain runway. They've got to do something. So there is a lot. I would say there's a lot of discussions going on amongst the different big players. There's nothing that I would say would shock me today, but I would say at this point you're going to see. I do think you'll see some consolidation among the bigger players because the timing is right. And so from that standpoint, I think think big, because I think there will be several big things that will happen in the next 24 months. I can't say it's in the next 6 months, 3 months, or 12 months, because these things are complicated, but I think that will happen. I also think you'll see some of the lower performing platforms divesting of assets. So I think you're going to see some of the bigger players that had less success in this space will be getting out of it. And I think you'll see continued very, very aggressive growth by Quick Quack and the clubs of the world. So it's good. It's going to be, I think, a very robust couple of years here.
Would it shock you if a car wash chain went public this year? Would that be shocking to you?
I don't think so. Nothing. There's certainly it's so far it's not proven to be a space where there's enough public interest in car washes to invest behind on the public markets. I just don't know. But certainly, when you look at the financial partners behind some of these groups, whether it's you take Quick Quack with KKR, these are sophisticated groups that are getting involved. So who knows? It wouldn't shock me. And again, I'm not, nothing I'm saying here is going to be, don't take it as me starting a rumor. I think at this point, it's just, there's speculation. I don't think there's anything off the table. There's a lot of discussions going on about the right path to create liquidity for these big players, and they've got very sophisticated partners. So, I think they're going to look at all their options.
Interesting. And Chris, where do you see the M&A activity in the car wash market in general heading in these next 12 to 18 months?
No, I think from a macro lens, it has all the markings between, stabilization in capital markets, have a debate about where, interest rates go from here, this point going forward. But I think there's at least more stability and clarity, which makes for, better underwriting and deal making. And then, of course, you have the regulatory regime. Globally, we're seeing kind of a loosening of regulation, very pro-business. You put all this together, and I think we're going to see a pretty robust M&A market. Specific in car washing, I think the motivations and the strategy is going to shift a little bit, more focused hyper focused on density within markets and fortifying in current markets, especially given some of the challenges that we've already referenced in the de novo space. I think the way to fortify and secure within a market is going to be through some larger scale consolidation and acquisitions to continue to create density in units. Going back to the comment in public markets, that's an interesting one, right? We've heard rumors for years of quick quack that they're filing. The reality was IPO markets weren't ready for it, right? It's been quite volatile in public markets. We are now expecting a better IPO market in 2025 and beyond. Does that create a better path forward for some of these sponsor-backed groups to monetize their investment? Potentially. But I think the one issue there is that there's certainly been a little bit more fatigue in public markets around Mr. Car Wash. So that being said, does that create a little bit of a headwind? So I think that to address that question, wouldn't be horribly surprised, just given the state of capital markets, in particular outlook for IPO markets. That said, though, does the market really want another publicly traded car wash company? And I think that's a big question mark today.
Interesting. Yeah, we talked a lot in 2023 and 2024 about headwinds that you just mentioned. Have those headwinds eased a little bit? How much when the Fed, changes the interest rate either up or down, does that have a huge impact on what buyers and sellers could do, or is that maybe overblown in certain circles?
I think looking back at it, right, it's not necessarily, these 1 to 2 movements in 25 basis point increments, that's tolerable. But if we go back to 2023, the speed in which the Federal Reserve was moving to combat inflation, that is radically disrupting, right? Because there's a couple of different relationships there. First and foremost, cost of capital. Right? When you're borrowing at mid-teens in your private credit facility to take down a deal, your margin for error is virtually zero. So, that's certainly a big headwind when you're in a rapidly increasing rate environment. That said, when you're on the way down, which we've been, it's a little bit more conducive. Interest rates, generally speaking, have that inverse relationship with multiples. Lower rates have fatter multiples, better for deal making overall. So I think that's very, while that was a headwind, in particular the M&A space, this is something that could be a tailwind going forward.
Yeah, and I think maybe just adding on a little to that, you also, what we had before was we didn't know what was going to happen with the consumer. Were we heading into a recession? Yeah. And so you sort of have the credit markets looking at this thing saying, okay, we're going to lend you all this money, and we could be sitting here with a recession and consumers pulling back, and all of a sudden you're dead. So there was, like Chris said, no room for either point. On a go-forward basis, I would say the biggest change is not necessarily been rates coming down dramatically. They came down a little bit, but the confidence level of the credit markets to lend. And so, now all of a sudden, we're finding a lot of platforms reload it, and they've got plenty of cash on the balance sheet to go buy stuff, because the confidence level in the consumer not heading into a recession is changed, right? They feel very good about where we're at here. So the credit markets opening up has been probably the single most significant thing that's happened in the last 6 months.
All right, sounds good. You gentlemen have both spent a lot of time with me today. Do you have time for another question or two, possibly?
Shoot, Rick.
Sounds good. So if I'm a car wash operator, and maybe I have a couple of locations, maybe I have tens of locations. If I'm sitting here today in January 2025, I think I want to get ready to start selling my business, preparing it for a sale, maybe Q3, Q4 of this year. Is there anything that I can do today to kind of best position my business to attract the most amount of sellers, get the best multiple I can get, the best value for my business? Or is there anything that could move the needle that I could start doing today to prepare my business for a sale in 6 to 12 months?
Yeah, let me jump on this one for now. I think when we take Epic Shine. Epic Shine is a great example of a really well-run company. So when our buyers toured those sites, looked at their financials, everything was in order. And they've got a very, very favorable valuation, right, on that exit. And just as good as they are, I would say there's a lot of operators out there that, don't quite look like that, right? So I would say there's a a fairly large checklist of things that I would be doing, everywhere from, what's their organization look like if you're going to hand it off to a seller, to how their books and records look, to how their facilities look. And so there's, I would say, and again, from an advisor standpoint, having the proper legal in place, the proper accountant in place, CPA, to the proper advisor, it makes the process much more efficient. They get better. They'll end up with a better result. But it's understanding what it takes to get top valuation. And so, and that's probably a list of 100 things that they've got to be working on. And so, I would encourage them to make sure, at least whoever they're seeking advice from, seek advice from somebody who really understands what a buyer is looking for, what are the best KPIs in the space, because there are adjustments they can make to their business that can absolutely improve their results. I mean, simple things. It could be their cost of chemistry. They could be spending, too much, and every dollar drops to the bottom line could be worth $10. Well, if you're doing enough of it, it'll add up. So I would say it would be getting the right advisor to give them the knowledge that they need to have to be making those improvements, because it does all add up.
Yeah, I think in general, the buyer pool has been more focused on quality more than ever. And quality means a lot of different things, right? Quality of your operations, the team you have in place, the depth of the bench, the training infrastructure you have to acquire new resources and get them plugged into your ecosystem efficiently and effectively across multiple units, critically important. I think, one area that Jeff highlighted too is the quality of your facilities. An area we see a lot of groups consistently trip up as they continue to grow is maintenance, and not deferring your maintenance, and having a strong maintenance program where you could abide by that 80-20 rule, right? Where 80% of that routine and diagnostic maintenance lives on site. I think the buyer pool is more aware of some of the challenges with integrating a new chain, both the culture of the organization with the employees, but also the meaningful CapEx need that may be needed for a physical organization or operation that may not have properly maintained their facilities. To making sure that you're not deferring your maintenance, you have, a tunnel that produces a dry, shiny, clean car every single time. Where you have the integrity of the equipment in place is also a very key consideration. That CapEx spend to get facilities back up to standard is very real. The buyer pool is aware of that today. Also, demonstrating a path forward for growth, right? What does your pipeline look like? What other opportunities are in market where you could potentially bolt on a onesie, twosie, or is there a path to expand by way of greenfield? So having a very articulate and clear growth strategy is also important.
Excellent. Great insight. I'm sure a couple of thousand members to the wash wouldn't help, but if you're locked in with operations and you got great facilities, those members should come, and that should also be a part of your growth strategies, including the membership trajectory. So in closing here, gentlemen, as we look at 2025, we touched on this in a previous answer, but do you just want to wrap us up with what could be the biggest surprises we could see in 2025? Do you have anything else to add on that as we look over these? We got a new president coming back into the office. So will the new administration affect anything when you look at 2025? What could be the biggest surprises or changes that you might see in the market this year?
I certainly think the new administration's given a shot in the arm, and I think there's a lot of excitement around, maybe extending depreciation, which will put some of the emphasis back in investing more in this space. But I still, I would say there's still about a lot of caution behind, like even the traditional commercial lenders that are going to lend the operators to scale up are still fairly conservative in their lending requirements. They're not going to be as bullish as they were back in the day. So, I think we're certainly we're enthusiastic about what's going to go on. But I do think there's still a lot more discipline from the buyer pool. So the seller's got to be somewhat rational about what they're going to do going forward, because sites have gotten expensive to build. Interest rates are still expensive. And so that hurdle to getting a return is not as good as it was back in the day. But we're seeing a lot of excitement back in the space. So from something big again going on, I would I would bet on one or two major things happening within the platform universe sometime this year. Don't know what it is, don't know who it is, but I know there's a lot of conversations going on.
Yeah, I think the talking about the administration, I think one key area to expand a little further on the depreciation aspect of it. I believe the current step down for this year is the 40% bonus depreciation. Now you think about that, what that means per car washer. You're putting about $1.5 million in CapEx in the facility. There's a lot of speculation that the first thing to be addressed by the Ways and Means Committee is reinstating 100% bonus depreciation, picking up that extra 60% on a what's called $1.5 million equipment package. That's meaningful. That incites growth, and that changes kind of the underwriting model of continuing down the path of growth. So certainly think, given all of the enthusiasm, optimism with the new administration, some relief in capital markets, given a more stable rate environment, definitely going to see a lot of activity. I think that what could be the big surprise of the year is where that activity occurs and potentially being some consolidation at the top end of that top 50 list.
Sounds good. Well, it's an evolving industry for sure. It's been fascinating to cover this market. Jeff, you've been riding with me pretty much since day one with this the podcast, and you never cease to not, you're always delivering great information. I'm always learning something new, and I can't thank you enough for all the time that you've spent with me over the years. And Chris, I know this is your first episode on Wash Talk, but we'd love to have you back for sure in the future. And hopefully this is one of many more episodes that you can contribute to. Thank you both for taking some time with me today.
Thanks for the opportunity to be on your show, Rich. As always, a pleasure.
Thank you, Rich. Appreciate it. Looking forward to coming back.